The cryptocurrency market is poised for significant transformation by 2030, driven by advancements in blockchain technology and increasing mainstream adoption. As of 2025, the number of global crypto users exceeds 410 million, with projections suggesting this figure may double by the end of the decade. Major corporations such as Tesla, PayPal, and MasterCard are actively participating in the crypto space, indicating its transition from a niche interest to a mainstream financial instrument. Additionally, several governments are exploring the introduction of their digital currencies, signaling a broader acceptance and integration of digital assets into the global economy. Blockchain technology, the backbone of cryptocurrencies, is anticipated to extend its applications beyond financial transactions to sectors like healthcare, real estate, and supply chain management. Innovations such as smart contracts and digital identities could revolutionize traditional processes, offering enhanced security and efficiency. However, regulatory frameworks remain a critical factor in shaping the future of cryptocurrencies. While some countries like El Salvador have embraced Bitcoin as legal tender, others, including the US and India, are in the process of developing comprehensive crypto regulations. The outcome of these regulatory efforts will significantly influence market growth and stability. Environmental concerns associated with energy-intensive crypto mining are prompting a shift towards more sustainable practices. Ethereum 2.0, for example, aims to reduce energy consumption, setting a precedent for eco-friendly blockchain solutions. This trend towards greener technology could enhance the public perception and adoption of cryptocurrencies. Furthermore, the rise of crypto has fueled job creation in blockchain development and digital finance, with the sector experiencing a 118% growth in employment over the past 2 years. As technology evolves and regulatory clarity improves, cryptocurrencies have the potential to become a fundamental component of the global financial landscape, impacting both economic activities and career opportunities.
Goldman Sachs CEO David Solomon has expressed concerns over the impact of President Trump's trade policies, particularly the imposition of tariffs, on the U.S. economy. In a recent interview with Bloomberg TV, Solomon highlighted that the uncertainty surrounding these tariffs is causing CEOs to curb investments and tighten budgets. He emphasized the need for clarity in trade policy to stabilize markets and potentially boost mergers and acquisitions (M&A) activities. Despite the challenges posed by the tariffs, Goldman Sachs reported a significant increase in trading revenue, up 27% year-over-year, as investors adjust portfolios to mitigate tariff impacts. Solomon's remarks come amid a broader context of economic caution, with Goldman Sachs economists lowering their U.S. growth forecast for 2025 from 1.5% to 1.3% and increasing the recession probability to 45%. The tariffs, introduced on April 2nd, led to a global market sell-off and contributed to a 13% decline in U.S. M&A activities in Q1 2025. These developments have raised concerns about Wall Street's profitability, with projections of a potential 20% decline in profits for 2025, which could worsen in a recession scenario. Despite these challenges, some optimism remains, as noted by investor Steve Eisman, who anticipates a revival in deal-making once trade negotiations are resolved.
The European Bank for Reconstruction and Development, EBRD, is set to establish its first West African office in Lagos, Nigeria, marking a significant expansion into sub-Saharan Africa. This move follows Nigeria's accession as the EBRD's 77th shareholder in February 2025, reflecting the bank's strategic push into the region, as approved by its Board of Governors in 2023. The Nigerian government, represented by Vice President Kashim Shettima, has expressed strong support for this development, viewing it as a milestone that underscores Nigeria's commitment to economic openness and reform. The Nigerian administration under President Bola Tinubu has been actively dismantling economic barriers, such as the opaque exchange rate regime and fuel subsidies, to attract foreign investment and stimulate growth. The opening of the EBRD office in Lagos symbolizes a deeper strategic partnership between Nigeria and the European Union, EU, with opportunities for collaboration in trade, investment, and youth empowerment. Ambassador Gautier Mignot, head of the EU delegation to Nigeria and ECOWAS, emphasized the EU's commitment to this partnership, viewing Nigeria as a key strategic ally. This development is expected to enhance Nigeria's economic landscape and promote regional stability, with the EU continuing its significant humanitarian efforts in conflict-affected areas. Additionally, Nigeria is exploring collaborations with the Asia Economic Development Committee of South Korea to advance manufacturing in solar technology, electric vehicles, and IT solutions, further signaling Nigeria's readiness for innovative and sustainable partnerships.
The recent analysis on Social Security retirement benefits highlights the ongoing debate about the optimal age to claim benefits in light of potential future funding issues. The Social Security Administration's trust fund is projected to be depleted by 2033, which would result in only 79% of benefits being payable. This has led to concerns among workers about whether to claim benefits early to avoid potential cuts. However, experts like Andrew Herzog, a certified financial planner, emphasize that while some fear benefits might be reduced, it is unlikely the program will run out of money entirely, especially for those already retired or near retirement. Despite the uncertainty, the general advice remains to delay claiming benefits until age 70 to maximize monthly payouts, which increase by 8% for each year delayed past full retirement age. This strategy is particularly beneficial for those expecting to live beyond 80 years, as it can significantly boost their financial security in later years. However, individual circumstances, such as health, other income sources, and personal financial goals, should guide the decision. For some, claiming early might make sense to spread tax liabilities or manage Medicare costs. But most experts agree that delaying benefits can provide a more robust safety net against unforeseen financial challenges.
On April 29, 2025, the Trump administration implemented measures to mitigate the impact of its 25% auto tariffs by signing orders that provide temporary relief to carmakers. These measures include credits and exemptions for certain imported auto parts, offering manufacturers a 2-year period to increase the use of domestic components while offsetting tariffs until April 2027. This initiative aims to address concerns over potential disruptions to North America's automotive supply chain, rising inflation, and job losses. Although industry leaders have welcomed this temporary relief, they continue to push for a complete removal of the tariffs to ensure long-term stability. Simultaneously, U.S. Commerce Secretary Howard Lutnick announced progress on a pending trade deal with an unnamed foreign partner, in line with President Trump's ambitious goal to finalize 90 trade agreements in 90 days. This announcement has contributed to market stability, with the S&P 500 achieving gains for the 6th consecutive day. Despite these developments, companies such as GM, UPS, and Electrolux are facing operational challenges and have adjusted their forecasts due to the economic strain of the tariffs. A Reuters poll indicates that the upcoming GDP report is expected to show slowed economic growth, highlighting the broader economic impact of these trade policies. Public sentiment on Trump's economic management remains mixed, with only 36% of Americans expressing approval, according to a recent Reuters Ipsos poll.
McDonald's is set to release its first quarter earnings report amid a challenging economic environment affecting consumer spending. Analysts predict adjusted earnings per share to decrease slightly to $2.68 from $2.70 in the same period last year, with revenue expected to dip to $6.12 billion from $6.17 billion. Same-store sales growth is projected at a modest 0.8%, a decline from 1.9% in Q1 2024. This follows a disappointing fourth quarter impacted by declining sales and an E. coli outbreak, prompting McDonald's to introduce new value offerings to attract budget-conscious consumers. Despite these challenges, McDonald's stock has risen over 8% this year, outperforming the S&P 500, which has declined by 5%. Analysts from UBS and HSBC maintain a positive outlook on McDonald's, viewing it as a defensive stock that could withstand current economic uncertainties, similar to its resilience during the 2008-2009 recession. However, geopolitical tensions, particularly the U.S.-China trade war, pose risks to McDonald's international growth strategy, especially in China, its second-largest market. Rising anti-American sentiment and retaliatory tariffs could impact the company's aggressive expansion plans, which include opening 10,000 new restaurants by 2027. As more than half of McDonald's revenue is derived from international markets, these geopolitical factors add complexity to its global operations. Nonetheless, the company's strategic initiatives and brand strength are expected to support its ability to navigate the uncertain economic landscape.
Tesla Inc. reported disappointing Q1 earnings, with automotive revenues declining by 20%, total revenues falling by 9%, and net income plummeting by 71%. These figures highlight significant financial challenges for the electric vehicle manufacturer. Despite CEO Elon Musk's increased involvement, the company's brand image has suffered, primarily due to Musk's political associations, which have negatively affected consumer perception, particularly in Europe. This tarnished image is seen as a potential proxy for declining sales in key markets. Tesla's valuation metrics, including an EV/EBITDA ratio of 65 and a PB ratio of 11, indicate that the stock remains overpriced. The company's high valuation, coupled with its brand image issues, has led analysts to maintain a strong sell recommendation, despite a recent rally in TSLA stock. This situation underscores the broader market sentiment that Tesla's current strategic and financial challenges may outweigh the potential benefits of Musk's involvement, casting doubts on the company's near-term financial recovery and market performance.
Agri-finance, a blockchain-based agri-finance platform, is reportedly in advanced negotiations with a major venture capital (VC) fund for a significant investment. This potential deal underscores growing institutional confidence in blockchain solutions within the agricultural sector. Agri-finance distinguishes itself by offering innovative services such as tokenized farm assets, which democratize agricultural investments, and DeFi lending solutions that provide farmers with low-interest loans backed by cryptocurrency collateral. Additionally, the platform incentivizes eco-friendly farming practices through tokenized rewards, aligning with global ESG trends. The anticipated investment could provide Agri-finance with the necessary capital to enhance platform development, increase marketing efforts, and expand globally, while also opening doors to strategic partnerships with institutional investors and agricultural cooperatives. The identity of the VC firm remains undisclosed, but industry speculation suggests it could be a prominent investor with a track record in Web3 and fintech startups. This investment aligns with a broader trend of venture capital interest in DeFi projects that address tangible problems rather than speculative ventures. The news of the potential investment has already positively impacted Agri-finance, with a noticeable increase in trading volume of its native token, $Agri, and heightened social media engagement. If finalized, this partnership could lead to increased adoption of the platform by farmers, investors, and DeFi users, potentially revolutionizing agricultural financing in emerging markets and setting a precedent for sustainable, blockchain-driven agriculture.
Recent options trading activity indicates a bearish sentiment among large investors, or whales, towards BlackRock, the world's largest asset manager with $11.584 trillion in assets under management as of March 2025. Analysis of 8 significant options trades reveals that 62% were bearish, involving 6 put options totaling $208,293, compared to 2 bullish call options totaling $59,300. This trading behavior suggests that these investors anticipate BlackRock's stock price to fluctuate between $810 and $1,000 in the coming months. Despite the bearish options activity, industry analysts maintain a generally positive outlook on BlackRock's stock. 5 analysts have issued ratings, with target prices ranging from $1,032 to $1,178, reflecting confidence in the company's robust global presence and diverse product mix. BlackRock's significant exposure to institutional clients, accounting for 80% of its assets under management, and its leading position in the ETF market support these optimistic projections. The mixed sentiment from options traders and analysts highlights the complex dynamics at play, as investors weigh potential risks against BlackRock's strong market position and strategic advantages.
Shell plc's initiative to divest its Indian renewable energy platform, Spring Energy, has encountered obstacles due to a lack of investor enthusiasm, primarily driven by valuation discrepancies. The Anglo-Dutch oil giant had engaged in discussions with Secura Energy, a platform under Edelweiss Alternatives, for selling a 300-megawatt portfolio valued at 1,200 crore. However, the talks were derailed as investor offers fell short by 15 to 20% of Shell's expectations. Shell's acquisition of Spring Energy from Actis in 2022 at an enterprise value of $1.55 billion underscores the strategic importance of this asset, yet the current market conditions have stalled the sale process. Further complicating matters, Shell's negotiations with India's state-run Oil and Natural Gas Corporation, ONGC, to offload a 125-megawatt solar asset in Rajasthan have also slowed. ONGC, which is aggressively expanding its renewable portfolio to 10 gigawatts by 2030, was initially the highest bidder. However, the deal's relatively small size and internal prioritization of larger projects like Ayana Renewable Power have diverted ONGC's focus. Despite these setbacks, discussions are ongoing, and a resolution may still be possible. The outcome of these negotiations is crucial for Shell as it navigates strategic shifts in its renewable energy strategy, potentially impacting its market positioning in the Indian energy sector.